Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, welcome to the Australian Property Podcast. This is our weekly 2 cents segment. I'm Pete Wargent. I'm here with Chris Bates. G'day, Chris. How's things?
Pete, life's good, mate. Happy Sunday to all our listeners as well. What's been happening in your world?
But just been a bit busy with buying property, funnily enough, past week or so. So there's a bit happening again. We went through a bit of a quiet patch where a lot of people were grappling with what's happening with mortgage rates, and some people actually looking at selling because cash flows have been quite severely impacted in some cases. But there's a few people actively buying commercial and residential. So that's been keeping me busy. How about yourself?
Yeah, I'd say that's pretty similar here. We've seen May, June time was a little bit scary, I guess, because people were a little bit unsure about where rates were going to go. A lot of investors were freaking out a bit. I think that storm's calmed a little bit. RBA pausing the last couple of months, and we've seen absolutely some huge inquiry. Last week's a little bit quieter than the previous weeks, but that's just what happens. But we definitely saw some, lots of purchases happening over the last couple of months. So the buyers are there, but it's an age-old problem. I think there's this belief that we're, third week into August right now, and there's this belief that lots of great properties are going to come on in the next 2 or 3 months. It's what the agents always like to talk up at this time of year. I just highly doubt it. I think there's going to be a real challenge finding good properties the next few months because, if anything, I think that May, June time is usually when, if you think about it from an agent point of view, is usually when an agent's hunting pretty hard for spring listings because it takes a few months to, get tenants out or to paint the property and style it. And, it doesn't list straight away. And so that was a scary time for buyers and sellers. So I reckon sellers at that point said, oh, no, we're not selling in spring because I'm worried about where interest rates are going. I don't want to upgrade. And then that didn't happen. Rates didn't go through the roof, anymore. And then so I don't think I don't reckon we're going to see lots of listings coming on. I mean, what are you seeing, Pete? Is it still pretty dry up in Brisbane?
It is. I think for anything half decent anyway. It's funny because we get these off-market opportunities sent to us, but the number of times our agent will turn up and then there's 2 or 3 other buyers agents there. It's very frustrating because we're all facing the same problems, right? There's just not that much quality stock coming on. And I did see just in the past week or so, the unemployment rate in Australia just finally starting to tick up. I think it's, was 3.4, 3.5, well now it's 3.7, which is still very low, but it's the highest in 14 months. And I think if you look at some of the other measures, people are underemployed or underutilized. It's just starting to soften now. So I think that's the thing. We've been looking at the major banks, Westpac, CBA, all reporting their mortgage arrears, and they haven't really moved a lot. But if people start losing jobs, then that could change the equation a bit. So at the moment, it's still very low unemployment, but yes, so far anyway, yes, there's been a bit of sort of listing activity, but it's still August, so we'll see what happens when spring comes around.
I think with buyers are always in the market if they're confident around their position financially, right? You don't go and try to buy a home or an investment if you're worried about losing your job. And so absolutely, if unemployment starts to, increase, that'll be less buyers, but it's glass half full, glass half empty. I mean, there's 96% of the population are employed, I guess. And so they're most likely going to be the buyers in the market. And unemployment may lead to more sellers down the line if, you can't get another job and they're running out of buffers and banks. But I think that's a real slow process because people don't just rush and sell their properties. The banks will play ball with you, especially in that situation, give you payment holidays and things like that. So, yeah, I do think even if there is a higher unemployment rate in the next, that doesn't necessarily mean that the housing market's going to soften. We're interesting to see how I play this out. There's 3 good stories this week, Pete. Maybe give us an overview of what we're covering this week.
Will do. Yeah, I've been chatting to a few people actually down in Adelaide, and they said the Rask Roadshow down there was fantastic. So if you haven't got your tickets, there's still a few shows to go. Yeah, well, there's quite a few shows to get tickets for still. So do come along. I'll see you around the traps at some of those. So we're on a mission to become Australia's most trusted property podcast, and every Sunday at 7 a.m. This is the 2 cents segment, which will be waiting for you on the weekend. So the big 3 news stories of the week that we'd like to cover each week. So this week, we've interesting piece on, I think it was on LinkedIn actually, from Scott Keck, talking about why don't we make better use of Australia's spare bedrooms. Something that comes up in the census every time is we've got not only some empty dwellings, but we've got a heck of a lot of empty bedrooms. But because of the tax system, that often get utilised. So he made some interesting suggestions or recommendations, which we'll run through. Secondly, on global markets, the big story over the past week, Evergrande, having reported losses of over $80 billion over 2 years, has finally collapsed and filed for bankruptcy in New York. So that's China's second largest real estate developer. So we're going to take a bit of a sort of a thought process there in terms of, is there any potential contagion risk? What might it mean for Australia? And thirdly, just a bit of a market update, I guess. Brisbane is now the house price leader. So quite a change from some of the doom and gloom predictions from some time ago. Brisbane has actually seen price growth of over 4% over the past quarter, actually ahead of Sydney now. So we'll take a bit of a look at what's happening around the tracks there as well. So, Chris, let's start off with this Scott Keck article on utilising spare bedrooms. So every time in the census we have this these reports come out, and there's a million empty homes, which I think is a bit of a furphy, because the empty homes, it's often people like me, I'm overseas or on a campsite, or it's not always necessarily completely empty housing stock, and quite often there's new builds or people haven't moved in and whatever else. But there's certainly always a huge number of unused bedrooms. I think 13 million unused bedrooms in the last census. So some interesting suggestions there on what we might be able to do to solve the rental crisis.
Yeah, I think it's a really good way of affecting things immediately, right? Like the government's 1.2 million homes they're looking to build over the next 5 years. Like, yeah, that's going to potentially, that desire to set a target. And yes, if we build more than we were planning to, that's going to be good. But it's going to take years to get developers and creating more supply. But this is something you could untap straight away. A policy could come out overnight, and we could start to better utilize people's spare bedrooms and spare granny flats and things like that, just because the tax settings that we've got in Australia don't really make that attractive. I guess that the empty homes is an interesting conversation. I mean, a lot of investors go, well, I could rent this thing out. It's pretty run down, but, the hassle of renting it to get, $300 a week, and then I have to pay tax on that, and then I have to manage it. I might as well just leave it empty, right? And I think there should be some type of targeting on investors who aren't renting out their properties. And there should be some type of vacancy tax, or, and I think that's happening in Victoria. I'm pretty sure I think there's a real understanding of, properties that are underutilized, that people aren't living in. And even if you're living overseas, like, should you pretend in the place that's just vacant, should there be some type of extra tax or something? I do think it's a conversation to free up some of our housing stock that's people aren't living in, because there's a homelessness problem, there's a rental affordability crisis, and this is all feeding into a house price crisis, to be honest. A good friend of ours up on the beaches, caught up with them on the weekend. They're renting a house up here, and they had plans to stay there for many years. The investor, a landlord, told them to stay there for years, and they've been given notice. And it's extremely stressful for them. They've got 2 young kids like us, and trying to find another house, etc. So I know that's just one story, but it's these problems are widespread. So I think that the empty homes is a good idea, Pete. But Scott was more referring to people with empty bedrooms and empty granny flats. Maybe give us a taste of what he said.
Yeah, I think that's the thing, isn't it? If you're somebody who owns a home, I don't think it might be talking about it, because we discussed it on a podcast. Cameron Cusher, I remember him saying on social media a few years ago, he's at the REA Group, senior analyst there, and he was saying we've got all these spare bedrooms for when people visit from overseas or friends and family and so on. But he said for half the time we just don't use them, and I think that's a very common story. Now, at various points in your journey, I know my wife had boarders in her early years of home ownership to help her afford the mortgage, which always has its pros and cons. And when you're younger, you're sort of happy to go with that. Then it's harder as you have kids. I think, so what Scott's suggestion was here is that maybe the government should consider, say, a 3-year moratorium on rental income that's earned from allowing people to use a spare bedroom. I think one of the things that really puts people off from doing this is that it starts to get messy from a tax point of view. So the principal place of residence, of course, is capital gains tax free when you come to sell. But if you start renting out bedrooms, and then people start thinking, oh, hang on, what about the impact on my pension? What about when I come to sell the property? Is this going to create CGT issues? And I think his point here is a very valid one. Well, if the government was to say, look, we're in a rental crisis, we're getting more people going to share housing anyway because of the lack of available rentals. Well, why not say to people, if you make a bedroom available, there won't be any impact on your capital gains tax-free status of your home. Now, there are some other, potential, risks here in terms of, how does it all work from a legislation point of view? But it's certainly an idea that could certainly usher in millions of bedrooms, and as you said, quickly. It's something that could be implemented pretty quickly. So, it makes sense to me. What do you think?
Yeah, and I think the even just Airbnb-ing it, right? If someone goes away for, we went to Fiji, as most people probably know on this podcast, it's not incentive for us to put it on Airbnb. First, we've got to pay Airbnb. Then we've got the hassle of, managing that and, kitting our place out, etc. But ultimately, if we make any money on that Airbnb, then I've got to pay, tax on that, right? And then I've got to potentially affect my CGT, the capital gains on the property, and I've got to do a calculation there. It's just all too complex. But if that money was tax-free, and maybe you said to people, look, and this is where I think that the government would have to take a bit of a hit here. They potentially couldn't say it's only for new people, then existing people who are doing it would say, hang on a sec, I'm not benefiting from this new policy. So they'd have to take a hit to their bottom line in terms of people who are Airbnb-ing their house now when they go away would probably benefit from this. And they probably were still going to Airbnb their house under the old rules and would have paid tax. And so, but, maybe it's you can Airbnb your house up to 90 days a year and you don't, and as long as you're living in it, then, you don't have to pay tax on that. So that would just create a lot of people with short-term accommodation in between. Just talk about that friend there. If they can't get a rental property by January, maybe they need to use an Airbnb for 2 or 3 months till they find a rental. But if there's not enough Airbnbs on the market. So I think there's a short-term letting benefit for some people, but then also a lot of people have got granny flats, self-contained sort of rooms at the back of their place, and would happily rent that out to someone, on a weekly basis, but just know the tax just doesn't make that make sense. So I think the key thing to what makes these ideas so well is the moratorium, right? If, and if we say for 3 years, not 1 year, 3 years are decent. If you just do it for 1 year, it's a lot of hassle for 1 year. But if you set it for 3 to 5 years, I think it's a really good idea. And hats off for Scott. I mean, Scott's got a big voice, runs a big company. And so hopefully that does get picked up by government. And it's really considered.
As he pointed out, I think if the landlord was a pensioner, then the extra income under the current rules anyway could actually adversely affect your pension formula, then your pension entitlement. So that could be messy. But I guess what he's saying in the article is this is a bit like in World War II when people had to come up with on a war footing, right? We're in a crisis here. And instead of waiting for 3 or 4 years for the next construction cycle to come round, why not look at doing something today, a bit like a war effort? I think he says in the article, a bit like, melting the jewelry to build armaments. Well, this is something that could be done today and done quickly instead of waiting, years. Because if you look at the apartment cycle, 2024, yes, there's some supply. 2025 looks like an absolute mess, just nothing coming on. So I guess under the current trajectory, we're heading for a rolling rental crisis that's actually going to go on for 2 or 3 years. There'll be ups and downs with the seasonality. I saw last month the number of arrivals into Australia, 1.75 million, departures 1.5. I mean, that's a shitload of people extra. And there's a seasonal impact there, of course, with international students and people coming back from holiday. But instead of allowing this just to run and run, I guess it's a quick fix solution that the government could do with a stroke of a pen.
And I think there's a demand for it. So it's, there's obviously a demand on the renter side, rental crisis, but I think there's also a demand from the owner of the property, because you think about it, mortgage rates are as high as they've been. They're higher than they expected. They've got mortgages they've got to pay. And so if that means staying in your home, renting out a room or two, you'd absolutely consider that, right? And that's going to make they can go directly to paying for their mortgages and would support the housing market, which, there's a whole story there. But, it does protect people who have gone and, bought properties, right? And so I reckon there's an argument to this. And so, Scott, I hope this helps in any way to get you a bit more voice behind it, because we think it's a good idea.
Beautiful. So let's crack on with the second story, Chris. So I guess this is something which has been bubbling along in the background for a little while. So China's second largest developer, Evergrande, is formally now, I guess, collapsed. So we previously saw that the company had reported, or the group had reported, $81 billion of losses over 2 years as the Chinese real estate market was sinking. I think this is something that probably for at least the past decade, people have been saying, well, look, China is this kind of crazy bubble economy. There's hundreds of billions of dollars of debts. And there was articles, over a decade ago about 60 odd million empty units. But I guess, this has gone on and on for so long that people have kind of got a bit complacent about it. And they've sort of taken the view, well, 60 million empty units or apartments, and that just seems to be a permanent state of affairs. And that's the way they do things in China. Build it and they will come. Well, just over the past year, things are starting to send a few shudders through the world's second biggest economy. So the China property sector, which I guess some would say is the second largest asset class in the world. You've got, the US stock market, then you've got China's property sector. Well, there's real turmoil there. The developers are failing to finish housing projects. There's people have gone on mortgage strike, and there's protests, and there's some huge developments there that have completely stalled. Now, Evergrande had $300 billion worth of liabilities, and the government was tightening, I guess, the scrutiny on the sector, and now it's basically, well, the shit's really hit the fan essentially, and the group has collapsed and has filed for a Chapter 15 bankruptcy in New York. Now, I guess, Chris, the immediate thing I always think when a major real estate developer would go down like this is what happens next in terms of not just the developments that are failing, but what about contagion? Because you've got other highly indebted developers like Country Garden and others, and I guess financial markets have sort of priced in a bit, but what do you think? There's potentially some knock-on impacts here, and including for Australia.
Yeah, I mean, it sounds a little bit like the taste of 2008, these things. That still feels quite fresh in a lot of people's minds, right? And when the banking market freezes up because there's a worry on who owns this debt, who's got this Evergrande debt, right? I think I've only done a little bit of research on this, but maybe it's $20-30 billion of, foreign debt or something, Pete. I'm not exactly sure, but, what bank's got that? Who's holding the cards, right? And, and I guess that's what happened in 2008. No one really wanted to lend to each other in the banking crisis. And, that's just the worry here. I mean, you could see I was just reading the notes here. I mean, in 2018, Evergrande was the largest, most valuable real estate company in the world, right? And they were doing all sorts of things. They were going into automotive, into sport, health, entertainment, finance. So, they were printing money basically all the way up to sort of 2020, and it's just all blown up. And it sounds like they were targeting more the middle to upper end of the Chinese, apartment market. So, yeah, it's. I guess in Australia, we did an episode a few weeks ago, I think it was, Pete, where we talked about Chinese developers all pulling out of Australia. What does that mean for our resource sector? If the Chinese economy doesn't need our steel and our coal, etc. How does that affect things? So I think there's a lot to play here, but I think the real worry in my mind is, does it mean that banks start to get worried about each other and say, who's holding the cards here? Who's going to have a big loss? And do I really want to lend money to them interchangeably between the banks? And so, yeah, what's your take on the real risk here, Pete?
I think that was the thing, wasn't there? When the announcement came out, you immediately start thinking, who are the bag holders here? I saw the, I guess 2 or 3 years ago, there's a lot of talk about whether Tether potentially had a lot of Chinese commercial paper, and the Bitcoin price immediately dropped 10%, I think partly as well because Elon Musk, the SpaceX was selling their Bitcoin or sold their Bitcoin. I think, yes, so that's the first question. Who's holding the bag here? And is there any sort of contagion risk? I think, as you said, we can pretty much forget Chinese real estate developers being active in Australia. The sector domestically in China is so messy that there won't be much development happening over here. I think there's only one sort of major development left now, which is central Barangaroo. Practically all other Chinese development is gone. I suppose coming the other way, over the years, we've often seen people getting money out of China, putting it into Australia. So there's certainly Jawai and others have been talking about Chinese investors getting active again after a sort of period there where nothing was happening during COVID. I think the other thing, yes, commodity prices like iron ore would come under pressure potentially if there's not the same demand for our commodities. But I guess that's the thing. If China genuinely goes into a recession, does that mean deflation? Does it actually pull down the Australian economy too? I think if you, as you rightly pointed out, 2009-10, as China stimulated like crazy. I mean, we sort of coattailed our way out of recession on that basis. And I suppose those are the big questions. Will China really collapse or suffer? And if so, what kind of stimulus will the government pump in? Because, of course, the Chinese government does have trillions of dollars that could potentially be pumped in. But it's, I think it's one of those things. Watch it closely, but don't panic at this stage.
Yeah, exactly. I think that's, watch this space. But I think it's not going to be a big contagion effect like it was in, a credit crisis. But at the start of the credit crisis, people didn't think that it would end up with Lehman Brothers going under, right? So, let's keep tracking this story.
It's like the old domino meme where somebody knocks over the first domino, which is something seemingly insignificant, and then it parlays onto the next biggest domino, and by the end, everything's falling to pieces. So, yeah, definitely. I mean, we've been talking about China and the bubble economy and debts and empty units for so long that it's almost like, it is what it is. But, it's not like the risk has gone away. It just hasn't fallen to pieces just yet. So definitely watch this space. And finally for this week, Chris, Brisbane has become the house price leader. Macro Business reported on this one. They seem a bit more bullish on Brisbane these days. Over the past quarter, Brisbane prices are up just over 4%, which is actually more than Sydney. So Brisbane 4.13% on CoreLogic's index, Sydney up 4.11. I think it's pretty interesting, isn't it, Chris? Sydney's prices from the lows are now up more than 8%, I think. PropTrack doesn't have Sydney prices, well, they're barely down from the peaks. They're probably 1% below all-time highs. And definitely a change of tenor in the commentary from where we were sort of 6 or 9 months ago. And obviously, with the usual caveat that some property types and locations have done a lot better than others.
Yeah, I think it's a real watching the supply and the listings over the next 6 months in Sydney, or even over the next 3 months, to be honest, up to the end of November. And if this positive news potentially continues, right? We're not saying that this is going to happen, but let's say the RBA doesn't increase much at all, right? And all of a sudden there's talk of rates have hit the peak. Then all of a sudden the only thing to talk about after that is when a rates cut's coming, because that's the next thing, right? If when are they coming, and how big are those rate cuts going to be? And if the market gets a little bit overconfident, the rate cuts are guaranteed and they're coming and they're going to be significant at some time in 2024. would you wait for the rate cuts to then potentially look to purchase, or do you want to get ahead of the game and look to buy before the rate cuts come? Now, I would say buyers at the moment, and myself included, don't want to bank on rate cuts significantly anytime soon, right? There's still that fear of, is inflation going to stick around? Is interest rates going to potentially have to go a bit higher? And I don't think the inflation genie's back in the bottle, but it's looking like that's heading in the right direction, right? So my worry is if the commentary starts to flip, the mainstream media, the domains, the real estates, the news.com.au's, the Sydney Morning Herald, the Age, etc. Right? If this starts the Channel 9 News, like, it can very easily flip. And that's what the mass market usually follows, to be honest. And if they start saying, CBA is expecting 1.5% rate cuts next year, and that's going to increase borrowing capacities 15%, and APRA is now kind of step in, and if that's what the market believes, that'll get factored into prices before it happens. And my worry is that the buyers are going to enter when there's very little listings on the market. When 2019, when we went into Sydney house prices were down 15%, and there was quite a lot of people still selling in 2018, right? And if you compare the number of listings on the market in 2018 in sort of the aspirational parts of our capital cities markets, much higher number of properties were on the market in suburbs, on a suburb by suburb level, than what's on the market in 2023, right? And so the market bounced back really quickly then when Labor lost the election, rate cuts and borrowing capacity went up. My worry is if there's talk of rate cuts and borrowing capacities going up, and it's a much smaller number of properties on the market, does that quickly get factored into prices? Do we create almost like a little mini boom scenario? And I'm just trying to talk the market up, but that's what I think is sort of happening right now. I think the buyers are still there. Like, we've got an enormous pre-approval list. We've got lots of clients that want to upgrade, and a lot of first-home buyers. Investors are definitely a lot more restricted because of borrowing capacity. But yeah, it doesn't surprise me. I think Brisbane's going to start to piggyback off Sydney. I do think more and more people are going to get forced out of Sydney pretty quick. Same in Melbourne. And Brisbane's just an amazing lifestyle alternative. I think that's what's really going to drive Brisbane consistently longer term, is that interstate migration, and the flexible remote work, hybrid work, head offices opening up there because they can get workers easier and it's more affordable for workers. I think that's what's driving the Brisbane story. What do you think, Pete?
Well, here's a quote from the Macro Business article. So Leith Van Ontelen, g'day Leith, if you're tuning in. He's got me blocked on social media, so I must have said something stupid years ago. I'm down in Melbourne in a few weeks, Leith, if you want to grab a beer. But this is a quote from the article. Big fan of your work, by the way. So there is a good reason to believe Brisbane will outperform its capital city rivals over the medium to longer term. According to Queensland's draft regional plan, which was published last month, an additional 2.2 million people will call Southeast Queensland home by 2046, raising the region's population to 6 million from 3.8 million now. So it's basically the fastest population growth in the country. By 2046, about 500,000 people are predicted to relocate to the Brisbane City Council area alone, as you said, Chris, raising the population there to 1.7 million. Now, I think the interesting thing here is that Leith likes to back up his assertions with some statistics and graphs and so on. Now, one of the graphs he's run here, which stood out to me as interesting, Brisbane house prices versus Sydney. The long-run ratio of prices is about 62.5%, call it about 2/3. So Brisbane's always been cheaper than Sydney. The current ratio, though, is only about, Brisbane is 54% of the typical house price in Sydney. So that does tend, when you get down to those kind of levels, to see people saying, well, hang on, if it's costing me half as much to move to another city, then you'll get that interstate migration happening from New South Wales to Queensland. So, and we have seen some of that over the past 2 or 3 years. So, yeah, it's an interesting concept. Often, Chris, so we have clients say to us, well, I've got a budget of whatever it may be. I've got $1 million to invest. Should I invest in Perth or Brisbane, or do I look at somewhere else like Newcastle, Adelaide? How do you go about in that situation, Chris, weighing up the various options? I think the thing that we often like about Brisbane is the potential to buy a house on a good block of land rather than being forced into buying a unit potentially in one of the more expensive markets?
Yeah, I mean, so really, it comes down to borrowing capacity. What's sort of their other assets? What's their future plans with their home, etc. And so it's not just quickly, right, let's go straight into and a cookie cutter approach. Like all our clients are doing different things, which is, different to a lot of people in the broking world or the property space. It's very especially when you're growing a business, is just to funnel everyone down particular advice. I find this with lots of property spruikers who are buying quantity. They, no matter what someone's budget is, they just keep on buying in this regional location because that's where they're buying with all their other clients. And if they can afford 3, then they buy 3 of them in 3 different locations that they're buying. So ultimately though, if you look at the fundamentals when you're looking at an investment and what's the right purchase price. So if you look at Melbourne, I'm very apprehensive looking at the apartment in Melbourne, personally in Melbourne. I just think that there's a constant supply that's going to come on. Very flat city, very relaxed planning controls in my mind. And they'll just keep building apartments and townhouses for fun, really. I think it's going to never be a shortage of those. But the houses, right, in Melbourne, absolutely there's liquidity problem and a supply problem, right? And so the problem is, if you look at a lot of where the high income families in Melbourne want to live, your purchase price in these suburbs, and even potentially where they want to live longer term, like you're still looking well over $1 million, probably closer to 1.5, and to get into a decent block of land that a high income family would want to live in. So it's a high purchase price, but the problem with Melbourne, very low rents because of this, apartments, because of what they've been building. People just aren't forced to pay a lot of money in rent. There's options, especially because a lot of renters are singles, couples, not so much the family market, and they're able to, if you want to charge me $800 for the house, I can rent an apartment for $600. I might as well just do that and save a bit of money, right? And I can rent an apartment in an area I want to live because there's lots of them in the city or in South Yarra, etc. So that's Melbourne. Sydney, I think, is probably getting, 1.5 to 2, and, the yields a little bit better in Sydney, probably. There's a little bit of a problem with renting in Sydney for families, and they're forced to pay more money for rent in houses, I would say. But a lot of investors haven't got those budgets, right? And so I would say in Brisbane, though, it does make more sense especially under higher interest rates for investors because the rents are higher there. And potentially you can enter at a lower purchase price. You could argue on this, Pete, as well. But to get into a quintessential, family market, a good block of land in a good suburb where high income families and people are leaving Sydney, Melbourne, and they're moving to Brisbane, they'd want to live in these suburbs, right? Because they offer everything they would want to have in Melbourne or Sydney, like inner city life, access to cafes and great schools and easy to get to the city. They can't afford that in Sydney, Melbourne, but they can afford it in Brisbane. So that encourages them to potentially make the move. And so I think Brisbane's definitely heading to the top of the list again for a lot of investors because of the yield, because of the lower purchase price, because borrowing capacities are really tight. And because they can get, AAA assets, which is a housing market in scarce locations that high income families want. So that's a bit to it. We're definitely more eastern border, East Coast focused. We would say that, we think that those 3 markets have got great, diversity in income and professions and, are already pressure cooker cities. And got strong population growth. And we think that, if employers, if they were going to open up a head office outside Sydney, Melbourne, I think Brisbane's the next spot, right? Similar time zone, besides daylight savings, catch up there, Queensland. But that's where we focus. That's a long answer to the question, Pete, but it's a big question.
We can't do the daylight saving because it'll confuse the cows and fade the curtains. But it's an exact conversation I had this week, actually, chatting to a client, somebody inquired, and they were looking at Melbourne, looking around places like Brunswick. But when they sort of looked into it, the rental yield was like 2, 2.5 or something. Very difficult if you're borrowing at 6% to make all that work. Now, just to wrap up on Leith's article, Brisbane housing relatively affordable compared to its larger East Coast cousins, meaning that in the long run, Brisbane house prices should grow faster. Also, the Olympics in 2032 will spur infrastructure investment and strengthen Brisbane's position as a global city, increasing international buyer interest. So his view is the long-term ingredients are in place for Brisbane house prices to outperform the unit market. Has been something a bit different over the years. So I think that's it for this week, Chris. So Scott Keck's article worth a read on LinkedIn on how the government might look to use spare bedrooms. Whether or not that actually happens is another question. Secondly, yes, the Chinese debacle is definitely one to put on the watch list. I think Evergrande is an enormous group, and that's it's been teetering for some time. That's now toppled, and we're just interested to see if there's any contagion risk there. And interesting piece from Leith Van Onselen, macro business on Brisbane being the house price leader among the capital cities now. I think you're right, Chris. I think Western Australia and Perth, certainly over the past 20 years, has been the most cyclical market and somewhat tied to the fortunes of commodities. And it's so hard to predict this stuff. You know, it could be an amazing performer, or it might not. It's very hard to predict with the fortunes tied so closely to the commodity cycle. So who really knows? But yeah, I do love the city over there in Perth. That having been said, thanks so much everyone for tuning in. Don't forget, as always, send us your questions. We'd love to cover your questions. Chris will have to do another Q&A soon. Run through a few of the questions that we get sent in. You can catch me at Pete Wargent Blogspot, my daily blog, or at Pete Wargent on Twitter if you haven't got me blocked. And Chris, where can people go if they want to have a chat to you at Blusk?
Well, I'm actually going to a few at the Brisbane Roadshow, so I saw you there. It was good to meet you because this will be on after. But yeah, have a look in the show notes. We've got a link to the business. We'd absolutely love to have a chat if you're reconsidering what you're doing on the finance or property decisions. So yeah, happy Sunday to all our listeners, and thanks for joining us on this journey. We're loving it. We're probably 3-4 months into it, and I think we've over 20,000 people listen to the episodes. So we thank every single one of you.
Yeah, 23,000 over the past month. It's our best to date. So spread the joy, and we'll look forward to seeing you next week. Cheers, Chris.
Thank you, Pete.